Well, I just soon keep this pretty informal, so as we go through it, by all means shout, throw things at me. That's fine. I'd rather this be interactive and people ask a lot of questions than me just stand up here and nap the whole time. Before I even get into things, I should let you know, anything that I talk about today, do not view it as a recommendation in the legal sense, please. This is more just educational material, and our lawyer likes to remind me to remind everybody of that, and I will soon pay him another check for that. Again, this is my firm, Islandrod Investment Management. We are a value investing firm. I'll talk why we're in Islandrod of all places in a minute. I am a portfolio manager for two funds. One is the Tarpon Folio, long-term growth fund. The other is the Gecko Folio, which is a high-yield fund that I actually built because I had a Tarpon investor who wanted something a little bit more high-yield, a little bit more for her specific purposes. My firm is actually an RIA, a registered investment advisor. What that means, among a handful of things, is that I've actually taken a fiduciary oath, i.e. I'm legally and morally obligated to put my client's interests above my own. So it's a little bit different model than you might hear about on the brokerage side of the house. A lot of what we do overlaps, but there is a distinct, really legal and again moral differentiator between what a broker would do and what the folks at my firm and myself do. I also I like to underscore that I do eat my own cooking. I don't own any other stocks, bonds, mutual funds, anything else other than what's in Tarpon and Gecko. The bulk of my own family's life savings is in Tarpon specifically, and it's not my business to sell people financial products, anything like that. So I feel like there's as few conflicts as there can be in what we're doing. As Gil mentioned, anybody who knows me and my firm knows, not a big fan of the mutual fund model per se. There's some technical reasons, one of which is that large investors in mutual fund can actually force costs and or taxes onto the small investors through sales, but I don't really want to get into that too much unless people have specific questions. The point is, though, that I think mutual funds in and of themselves were a great idea when they first came out, 60 years ago. But if you just look at the performance versus the fees, on balance, 70 to 80% of them don't outperform the market. In other words, you'd be better off just buying a passive index fund, something that held little tranches of the entire market rather than try to do the mutual fund route. So as a result, I built my firm and my funds a little bit differently. And just to back up a little bit, I launched the firm in August of '08, so a little over a year and a half ago. Prior to that time, I'd spent a lot of time figuring out what sort of structure I wanted my funds to be. As a portfolio manager, there were really only a couple of real valid options. The first was to go the mutual fund route. One of the many problems with mutual funds, in addition to some of the conflicts that investors might see, is that it takes about 400 grand a year in OPEX just to get it off the ground. Didn't want to do that. I knew I was going to be an independent firm, wanted to own it myself, didn't want to go seek other capital from folks. You're also, as a portfolio manager, I think you're in a little bit of a box when it comes to how you can manage the fund itself. There's just certain regulations, certain things in the documents that support the mutual fund that dictate more or less how much of a particular company you can own, and I feel like, through no fault of their own, a lot of mutual fund managers are operating with really one hand tied behind their back because of the constraints that are inherent in the mutual fund structure. Hedge fund was also, really for a while, I sort of thought that's the way I would go. Again, big fan of Warren Buffett, and we'll get into that in a little bit. His model of the early investment partnership was the most appealing to me for a long time. One of the problems, though, with the hedge fund structure is simply you can't advertise. And I was going to be on an island, literally, down the Florida Keys, and that, more than anything else, really made me think hard about what I wanted to do. I felt like I needed to be able to advertise. I wanted to do or have a more traditional business in the sense, and just to not be able to really market it locally was going to be an issue for me. So, long story short came up with a structure. We eventually started calling it a spoke fund structure. It is a marketing term that my firm came up with. And if everybody in here had been on Wall Street for 10 years and I told you, well, we took a separately managed account approach to things, consolidated around 2 strategies and then just took that direct to the public, then that might make some sense. But some of the folks in the keys, some of my initial investors are saying, well, okay, what's a dividend? So it's just sort of a different level of I guess, marketing appeal. And we basically called it this spoke fund after a hub and spoke structure. A spoke fund, as we define it anyways, is a group of individually linked investor accounts that are all tied to one core portfolio that contains the majority of the liquid net worth of that portfolio's manager. So this is basically mine and my family's account. Again, got pretty much all of our life savings in this thing. And the investors that are coming on board actually opening up separate accounts. It's all linked. Thanks to technology, this can all be done pretty easily these days. So kind of a fine point, but the ultimate bottom line is that I am in it together unequivocally with all our investors. And it seems to be resonating to date in terms of people liking the model and liking how it distinguishes itself. Anybody been to the Keys, the Florida Keys? I know Kip has, Professor has. Okay, a couple folks, all right. You might not have even noticed Islamorada. It depends whether you flew or drove, but we are the second, actually, village as you come through Key Largo all the way down to Key West. One of the questions I get all the time, though, is what are you doing in Islamorada, man? Why are you trying to do all this? There's a handful of answers to that, one of which is it was convenient at the time. I'd previously had a job down there in Key Largo as an analyst at a little research firm. The other side of it, though, is, well, I mean, I like showing the slide. Take a look at it. It's Islamorada. It's fairly nice place to be, and life is really pretty good. Here's a snapshot. This is the Key Upper Matacumbe, where my house is actually down here. You can't see it, and the office is further up. But this is where we've lived, my family and I, from the last 5 years, and this is where we came from. We were in D.C. for about 5 years, my wife and I, before we ended up moving down to Islamorada. So whenever I start feeling stressed or bad, I'll toggle these 2 slides, and the world seems to fall back into place pretty well. So definitely a different, distinct place to live, and I wouldn't trade it for anything. I love being down there, and a great place to raise a family. This is reason number 1,000 umpty squad of why I like being in Islamorada, and I think this is relevant, at least I talk as if it's relevant to some of our investors. I feel like it's easier down there to ignore a lot of the noise that goes on in the market. I could not be in Islamorada if I were a trader, if I were doing merger arbitrage. There's just some types of investing that you probably need to be close to New York City, close to Midtown, or in a big hub, just so you're aware of everything going on, ambient noise and all that. Value investing, though, which we'll talk about in a little bit, it's not one of those. I feel like investing is something that should be done alone on an island. I mean, not necessarily literally like I am, but I think that that mindset of being very independent and thinking things through independent of the noise can be very valuable. Again, one of the reasons that I like being in Islamorada is at the time of all those headlines we just went through, the reality was it was one of the best buying opportunities in a decade. This is obviously after the credit crisis a year and a half ago, about midway through 2008, about here's where I left my old job, here's where I started putting things together, and clearly in terms of timing of the funds, just got lucky. There were some timing elements involved. I like to think that luck favors the prepared, and to the extent that I was prepared ahead of time, I guess that made a big difference. But the reality was we are doing fairly well, even on a little island in the middle of nowhere. The purple arrows here are actually where I did most. This is where we launched the Tarpon Folio. This is where I launched Gecko, and this is where I did some more buying in Tarpon right around that market bottom of March of 2009. So we also have very good margaritas if you're ever in the neighborhood. So Islamorada's good. This is our first year results. Excuse me. These are year-to-day results. For instance, from November 20th, 2008, November 20th, 2009, Tarpon was up 91%, widely exceeded my own expectations. I assumed that we'd eventually get to that point because there was so much value in some of the great companies I was buying. But the reality was I didn't think it would take a year. I thought it would take 3-5 years, and we got there much sooner than I anticipated, to be candid. Gecko Folio, again, that's our high income fund. Even that was up 70% in the first year, so clearly I feel like we're off to a good foot. And that was really my number one aim that first year, was to just put good numbers on the board. Unfortunately, we were able to do that with both funds. A little bit more about Gecko, and you can see Gecko ended up outperforming by about 39% over the S&P 500. This is a snapshot through the end of 2009, as it were, just because I had it handy. Top blue line being Gecko. And then this was Tarpon as well. Tarpon outperformed by about 55% that first year over the S&P 500 too. So clearly, again, had a great year. I do tell our investors though, don't plan to ever see this again. Yeah, I mean, part of me honestly felt like at the end of the year, okay, I'll just retire, go open up a frozen yogurt stand, because I'll never see, probably, knock on wood, I'd hope to, but the reality is I'll probably never see another year where we have 91% returns. Both these funds are what I'd call plain vanilla funds. I'm not using leverage, not shorting anything. They're just simply long only, buy and hold in the Warren Buffett tradition kind of funds. Some of the big drivers in the performance, and this is Tarpon now. We had three companies that basically doubled in the year: Alcon, Blackbaud, Google, which is just about as much as a layup as you can get, I think. Cogent Communications went up almost 125%. Discovery, International Game, JBT. So again, the fund itself was only 16 different stocks at its peak. One of the things we'll talk about in a little while is that I believe in concentrating your holdings, focused portfolios. And look, if you can make 67% return on something as big as Target in a year, then clearly there's some other factors. There's a wind at your back. But just as a snapshot, if I come back next year, just to be clear, the numbers aren't going to be anything like this. This was a bit of an anomaly. I'll take it, don't get me wrong, but it was a function of, again, that once in a decade, probably could be 2-decade opportunity to be doing that. So the point is, I guess my job is essentially I've got the best job in the world, I think. I basically sit around all day, try to figure out what companies are worth, and then buy the best ones as cheap as I can. My background is a little bit off the beaten path too. I should point that out for the purposes of today. I actually went to the U.S. Coast Guard Academy as an undergraduate, majored in management, but I felt like I was raised by engineers. Dad was an engineer, everybody I went to school with thought in that very analytical mind frame, and I guess to some extent some of that rubbed off. After I got out of the Coast Guard, I was in telecommunications for a couple years, eventually found my way over to be an analyst at an independent research company, focused initially on telecom. Worked for a hedge fund, Mayflower Capital in the DC area, and lastly launched a new research firm that was based out of Key Largo before I found my way here. This has been the dream for a long time, to be a fund manager, be doing this myself, and this was actually taken as I was putting Tarpon together. It was some long nights, as you can imagine. That's my daughter taking advantage of my lethargy, I guess. A little tattoo. But I do try to do things in a way that I can explain. This is my standard. If I can't explain why we own one of the companies we own to my oldest, who's now 5, then I might not necessarily want to own it. I'm a big believer, again, in just knowing what you own and staying within your circle of competence, which I'll talk more about in a second. Why do you want to be in stocks to begin with? I think a lot of people these days have that question. At least a lot of my investors seem to have that question, based on credit crisis the last few years, all the obvious reasons that are going on right across the river. The ultimate answer, though, is that stocks are the highest after-tax inflation-adjusted long-term return possible over all other asset classes, long bonds, short bonds, gold. This is not inflation-adjusted, but it does show you what CPI would do to that. So, again, I don't think that's necessarily new to anybody in this class. Yes, go ahead, sir.
Currency trading.
Currency trading? Yeah, Forex specifically, it's very speculative. I would distinguish that in a lot of ways from what I'm trying to do, but by a lot of reasons. But the fact that currency trading, it can be, I think most often, is more speculative in nature. And as I'll get into in a little bit, it's the difference between trying to guess what the price is going to be and trying to figure it out and compare. There are good currency traders out there, don't get me wrong. George Soros, for instance, I think people probably know of him. A lot of the big hedge funds do it. but it's more of a short-term speculative thing than going into something and say, you know, I want to be a long-term partner in this business and then buying a little piece of it, which is what I'm trying to do.
Okay.
Does that make sense?
Yeah.
Okay. So I don't do any currency trading. If you have currency trading questions, I am not your guy, but I'm sure the professor could point us in the right direction as far as who to talk to next. It is always important when you deal with investing or think about investing to keep track of your fees too. I think this is one of the easiest ways I could think of, and it wasn't even mine, I just stole it from some folks, to demonstrate how much annual fees can eat away at your returns over time. And I won't spend a whole lot on it, but you can read it just as well as I can. This is trying to show the impact of fees on $10,000 earning 10% annually for 20 years, leaving aside, you know, the probability of that happening. If you were to do that, note that your mutual fund fee would be right around between here, assuming that average still holds, which it probably will. The average mutual fund fee is going to charge about 1.73, so you're right in this block, which means it could be right around 40% of your ultimate returns after 20 years. You're really just forking over to the mutual fund company. So those little numbers, when you talk fees, they make a big difference over time. If you're earning more than that, the 20 years that you own the fund, in other words, it can balance out. It's not necessarily a bad thing, but more often than not, it is a bad thing because most funds aren't going to outperform the market. The other thing that I think is important for folks as they start thinking about investing in careers and finances is this as well. Taxes and trading also can take a huge toll. Yes, I'm sorry, go ahead.
The annual fee.
That's assessed on the value of the portfolio. All mutual funds charge basically a fixed percentage based on the amount of assets that you send them. So they will take basically 1.73% of that amount and just put it right in their pocket.
Even if you have negative returns for that year?
Yes, good point. Yes. Yep, mutual funds, there's no performance fee aspect associated with mutual funds. And not only will they charge you that even a down year, but you may still even pay taxes on a down year just because they're carrying forward capital gains from a year ago. So you talk about ways to torque people. It's one thing to be down 40% in a year, but it's another thing to have your investors down 40% in a year and then tell them they still got a tax bill coming. There was a few investors that found their way to me just because we built things a little differently, and that was again, it goes back to some of the problems inherent in the mutual fund model per se. Does that help you?
Yes.
Okay, okay. Yeah, again, taxes and trading, a big deal. Specifically, again, you can read the header just as well as I can. The point here, though, that the average mutual fund, again, has a fairly high turnover. It's almost, 100% turnover would mean every year they're rotating all 50 positions that they own out. Right now, it's just a little bit under that. I think, though, what we'll see is last year that my hunch is that the turnover in the average mutual fund was probably significantly more than that. I would say 150%. Some of that is a function of people just trading too much, maybe short-term focus, but there is also a function of valuation. And I will tell you, for instance, that our Tarpon Folio had about 60% turnover last year. Wouldn't otherwise do it, but the reality was things went up so quickly, had to bring some new names in there. I don't ever want to own something that's overvalued. But even on the average year, when the market as a whole is not up 35, 40%, the turnover is high, and it will really eat away those returns. Again, you can see the effective rate of return after the average mutual fund. It's around a 4%, 400 basis point difference between what you think you're earning and what you're really earning. So, just I go through this stuff just because it's important, I think, as you're starting to get into investing to think about it.